Welcome to the next edition of Pizz-Spectives. My name is Pizzichetta, founder of Mont Wealth, and excited today to reintroduce Jolon Knight, a portfolio manager of Hyperion Asset Management. Now, Jolon, can you believe it was only 7 months ago that we were chatting about DeepSeek and how big a concern that was? Crazy.
Yeah, right.
Yeah. It's been pretty quiet since then. Not much has happened.
Yeah, no, nothing at all.
Firstly, Jolon, congratulations on the Hyperion Global Growth performance, especially consistent outperformance or alpha. Can you remind the listeners a little bit about Hyperion, who you are and your investment philosophy, please?
Yeah, sure. So Hyperion, we're a growth investor. We look for growth equities. We've been investing in growth as a style since 96. We've got our two domestic products, which started in 2002, small cap fund, the large cap domestic fund. And we launched the global product in 2014. So just over 11 years we've been. And what we're really trying to identify are the world's elite businesses. It's really like 1% of companies that are able to retain their return on capital, or return on equity, EPS growth at double-digit rates over long periods of time. And that's the area of the market that we're trying to play in. Trying to find these really high-quality businesses that have sustainable earnings and organic growth, so they can effectively positive growth in any type of market environment. Sounds easy, but the devil's always in the detail, and we spend all of our time trying to find these companies that can grow consistently over long periods of time.
Yeah, fantastic. You've done a good job of that so far. Now, before we continue, just wanted to provide a general advice disclaimer. Anything we discuss today is general advice only. Anyone acting on that advice does so entirely at their own risk. Please come and speak to myself if you would like to learn a little bit more about Hyperion. And obviously, Jolon will probably highlight later. You can go to the website and do a bit of reading, and there's plenty of information there. So, Jolon, we've just gone through US reporting season, and July saw some strong results, and I'm sure you're finalising your August numbers, given it's the first week of September. But some of your holdings like Palantir, Tesla, Spotify, and then also ASML and Intuitive had some mixed results. What were some of the key takeaways from the portfolio, and we can share with us, please?
I think on balance, this is probably one of the most encouraging reporting seasons that we've had really since 2022. In 22, everyone thought the world was falling apart, but earnings growth within the fund was north of 35%. It was really strong. It was really encouraging. As we're stepping forward in time, and the duration effect starts to step away, the companies that we hold have done exceptionally well. And the reported results, while they're really encouraging, and it may not be moving the share price, for looking forward statements that are phenomenal. Even Tesla, the result financially wasn't their strongest. Actually weak, with the car sales not as being as great as what many people thought it would be. It was a fairly well-known fact for us that the car sales weren't great. They're scaling up their self-driving technology, which is real. It's happening right now. And the robo-taxis are launching in other cities outside of Austin, Texas, and opening up to the public, which will scale into the end of the year and through into next year. And so we're actually really excited about the forward-looking statements that Tesla provided, and their technology actually starting to get disseminated around the broader communities, which is phenomenal. It's the investment case at this stage. And the cloud service guys are hoovering up revenue and earnings as the proliferation of AI continues to seep through. And you saw that with something like Palantir is starting to unlock into more and more businesses because their cost of implementation is way, way lower. It's not millions, it's hundreds of thousands of dollars now. So anyone can use it. And the return on invested capital from something like Palantir is 2.5 times, which is really exciting. And the Spotify is something that everybody uses. The results were fairly baked in. You probably, if you're using it, we've just realized that the price has gone up. The guarantee that I'll always use, the price of Spotify will continue to rise because you're not going to get rid of it. What else are you going to use? And that's giving them massive amounts of money and leverage as well, which is really exciting. So the whole portfolio in our mind is probably one of the most exciting results that we've had. And I'm sure we'll dive into detail on why AI is such a very strong theme that we're leaning into currently.
We sure will. And hello to all of our Spotify listeners, Jolon. Now, obviously, Microsoft is a big holding in the portfolio, as some of these cloud businesses are. What did the results give you the sense of the continued growth in that space?
Yeah, well, it's probably important to step back and think about, because Microsoft's done exceptionally well as that 365 licensing started to kick into gear. And that was really the start of cloud compute. And that was in the late teens of the last decade, which everybody got really excited about. But the next iteration of cloud is now AI and computations in AI. And that's why Microsoft and Amazon and the like are doing so exceptionally well at the moment. Is that cloud compute is growing at an exponential rate. It's not linear. It's actually really lifting off. That did 37% growth, which just gone, which is phenomenal. Microsoft's the second largest holding in our portfolio. But I might just share a screen with you, just to give you a bit of an understanding of how we're thinking about AI currently and why it's going to be a powerful driver into the future. And Microsoft's at the crux of it. What we've got here, if you can see it, is effectively the artificial intelligence or machine learning value stack. Just to give you an understanding of how revenue lines will continue to grow and how important each of these companies are across the entire stack. The real simple part of understanding it is these three sectors going down. So who manufactures the chips, who designs the chips and the architecture, and the infrastructure, where do those chips then go? So we own ASML, another company that we don't own that's on here is something like a TSMC. These are the guys that are building the chips and making them for pretty much everybody on the planet. The next leg up from that is where it gets really interesting. It's the design and the architecture of these computer chips or semiconductors. Now, Nvidia is a name that a lot of people are probably familiar with. They don't make the chips, they design the chips and they give them to someone like a TSMC to build. And their GPUs, the graphic processing units, are being used in cloud and in other devices to do parallel compute, which is what AI and machine learning needs. And there's another business that just recently bought in the past week called Arm Holdings. It's a British company. They don't actually build chips, they don't design chips. They sell their IP for the compute that happens in the chips to the chip manufacturers and chip designers. And they get a royalty for every chip that's made with that IP that sits in there. They've had a lot of success through mobile phones. 99% of all phones have some type of IP in them. And they go everywhere. Effectively, any digital device that you have will have some type of IP in it. To your phone charger that clicks into the wall, to your pods that sit into your ear, to any type of device in your house that has some type of digital component, probably has some IP in it. So very far-reaching. Then the next layer that you go up to is infrastructure. So that's cloud and mainframe in the old world and so on. This is where it starts to get interesting. So it's not just the cloud compute guys that are there that actually own the infrastructure where all the compute power occurs. Yeah, they're leaning on Nvidia and Arm to power these processes that are inside their cloud. And as the proliferation of AI machine learning compute continues to grow, the need for cloud compute continues to grow as well. And that's why Microsoft's and the AWS are doing so well at this stage. And that's really being predicated on the next level, which is software and services. And to think about where someone like a ChatGPT, all that, they sit in between these two here, providing an API and access point for their models, the AI models, to flow into software as a service. And we've got exposure there. And then where it gets really exciting, again, is up the top on edge devices. And so think a self-driving vehicle or a smart camera that police officers wear that usually takes all the data in. So just to give you a bit of an understanding, it's not a linear progression. There's a lot of side-by-side parts and moving in different times. And companies like Arm and Nvidia and Microsoft and AWS are integrated at multiple stages of this. And we're only at the infancy at the moment. Think of ChatGPT. In July, they had 700 million weekly users. Last month, August, they had 1 billion weekly users. So you're getting an exponential growth. Obviously, it's a digitized world, but it took Facebook about 7 years to get to 1 billion. It took Google 5 years to get to 1 billion users. And within about 8 months, GPT is already there. And so we're seeing real use cases for AI and machine learning right here, right now, today, that are only getting bigger because we haven't really filtered down into those software services and edge devices yet. And that's what's really exciting us and leaning into this next big leap forward in compute and big data and the Internet of Things, as we heard 7 or 8 years ago.
Now, a lot of the critics will say we've priced or we've lived way ahead of reality in some of these valuations, some of these companies. And there's a lot of similarities between price to sales multiples now versus dot-com bubble. Can you talk us through or give us some comfort as to why this might be different or some of the similarities that you are seeing?
Yeah. So if you think back 25 years ago, which it is now, when I first into the industry, there was no revenue behind any of these things. The internet didn't actually start until these bad boys came around. And that's when monetization of the World Wide Web really started kicking into gear. The dot-com and the bubble that burst was from wild valuations from companies that had no value, no revenues at all behind them. Today, completely different. We're in a digitized world. You're relying on your phone, your laptop, your tablets, your TV for streaming and so on a daily basis. And there is real earning streams behind this. You have a look at someone like Microsoft that is building out their data center at an incredible rate, and they're doing an extremely good job of their capital management, probably the best out of most of the guys out there. You can have 39% revenue growth in building a cloud business, and for that to be a bubble, there's not enough utilization, not enough cloud compute power out there for the need and the desire for these AI processes, which are coming and which are already effectively here. I gave the example of 700 million to 1 billion weekly users, and that's monetized. That's being monetized as it is. Yeah, they're not parallels. They're not the same at all. You're trying to put a leap forward in technology that has real earning streams underneath it in a digitized world of today versus 25 years ago when we didn't even have smartphones. Most people didn't have personal computers. Nobody used email. Nobody used the internet because it wasn't really real then. It wasn't great. You're still using your floppy disks and CD-ROMs back then. They didn't monetize like you do today.
Yep.
So to try and draw a distinction between the two, quite frankly, is a very narrow-minded and a not very educated view. It's actually happening and occurring in marketplace. We're seeing real use cases for AI machine learning already, like Axon, a company that we added over the course of the past 6 months. They own the police taser business, which you probably see the big yellow thing in people's pockets. Every police officer in Australia, and most of the ones in the US that have that body on camera, when they have that camera on, is listening and watching. And the software that sits behind pre-populates the end of the day police reports, which is a massive efficiency gain. Yeah. That's AI machine learning. And there's revenue lines that come from that. Tesla's robotaxi, that's AI. Your Spotify giving you new songs, that's AI. Now your search, when you jump onto Google, you use GPT, the predictive text that it rolls in, that's AI. And so we're already using it. You just don't realize it, but it's here and there's revenue lines attached to it. And that's only going to increase and get bigger as we step through time. Yeah, we're actually, to say we're excited about what the future looks like is a gross understatement. It's really exciting what could eventuate from the technological advances. If you're a skeptic and you don't believe it anyway, the companies that we own are phenomenal. They are really high quality businesses. There's net cash across. There's no debt or net debt in the companies that we own. They've got earnings growth of 28% until June 30. So really strong earnings. They've just got this positive optionality coming from AI and machine learning, which will drive them forward anyway. So you've got this great hedge. If AI machine learning works, you've got the world's best businesses. If it doesn't, you've still got the world's best businesses with earnings. So it's a really exciting time to invest.
Yeah, and you spoke about the earnings growth up until June 30, and I love the chart that you always present on the longer term structural growth that the companies in the portfolio have got. Has that changed since June 30, or is it still above 20%?
No, so we've actually really running about 28% up until June 30, and we're forecasting 23%. And it's a bit elevated at the moment because you're still stepping away from some of the efficiency gains that you got through the COVID period, and it should normalize back down. But then there's also going to be pockets where we're above that 23% and probably periods where it'll be below 23% as well. But yeah, that's elevated from historicals, and we've refreshed the portfolio more recently. We did it in 2020 when COVID hit, and recently now added a few names and took a few out, and that kind of keeps that return profile high to the point where the internal rate of return, and this was till June, so it's a little bit higher now, is sitting at around 22% per annum, forecast over the next 10 years. Historically, it's sat at around 19% per annum, and that's roughly what we've been able to produce for our investor base. So it's the return profile is still looking really strong, underpinned by really strong earnings. And then living in the future, you've got that AI machine learning thematic, which is really driving these businesses, which is exciting.
So patient investors will be rewarded in this case. Which is
yeah, absolutely. And to be fair, the market's gone sideways the past 3 or 4 months as it's digesting all this information and a lot of the tariff noise. And it is noise that's going on out of the US. But you think, as we move into the back of the year and early next year, some of these revenue streams, which I've been speaking about, will become very apparent, and we're hopeful that it should start to roll through.
Yeah. One thing that I've always loved about Hyperion is its active management and really keen focus on structural tailwinds and growth companies. Interestingly, when we spoke 7 months ago, you didn't own Nvidia, but during the market pullback in between then and now, you've actually added a chunky position to the portfolio. Can you talk about how you use that market volatility to actually build a position?
Yeah, so Nvidia is a company that we've watched for probably 7 or 8 years, and you think it's history. It came out of gaming, graphics processors for gaming, and then, oh gee whiz, these things are really good at mining Bitcoins. Used there, and then people realize that the parallel compute that you need for graphics and Bitcoin mining is phenomenal for AI and machine learning, and the proliferation of their software or their chipset has gone into data centers for inference. And the share price, to be fair, over the last couple of years has gone up probably around 5 to 7 times. And in our mind, that was just pure speculation of how many GPUs can you sell into a cloud service provider in the next 1 or 2 years, which is really hard to get a handle of and a really hard thing to speculate on. And so we've really loved to see this company grow, but what we've really started to get an understanding of is, what does the end markets look like for these businesses in a decade's time? And so what we've done is build the end markets for inference in cloud compute, in automation, and in robotics in a decade's time. And does Nvidia have the right to have ownership in that time? And we think it does. And as that is our basis, we can build a position, have a better understanding of what the revenue lines look like in time. They currently sell about 5 million CPUs or GPUs, and we think they could probably double that over the next decade. And, and a lot of confidence that they'll still be market leaders over that time. They're one of the most competitive companies we've ever seen, as they're bringing out new chips and revenue lines every 6 to 8 months. Yeah, it's a really high quality business that we've been able to add.
Yeah, fantastic. And the timing was impeccable, really, the way you've used that volatility to soak up stock.
Yeah, that drawdown event that you had in April and into May with the Liberation Day tariffs gave us an opportunity to refresh the portfolio quite a lot. And so we added, I think it was 4 names over the course of the last 6 months, and sold out a number of others, about 6 names. As the lower weights, your confidence gets tested when a drawback comes. If the IRRs of the rest of the portfolio are rising and some of the things on the bench start to look more attractive, should we be allocating capital to the things that are like 1% or 1.5% weight lower, or are there better opportunities? And inevitably there was. So we think we've done a good refresh rolling forward for the next 5 to 7 years.
Yeah. So we've discussed Axon, we've discussed Nvidia, we've discussed ARM, and Hemnet was the other one. So is that realestate.com of Sweden, is it?
Yeah, the easiest way to have an understanding of that. So it's the same type of model, like the vendor paid, the seller pays for the advertisement. They've got complete market dominance over 9 out of 10 houses that are sold in Sweden goes through Hemnet, similar to here in Australia with realestate.com, but a little bit earlier in its life cycle as well. It's a small company, so the weight's actually low. We've owned realestate.com in the domestic fund since 2004. We still own it today. So it's a business that we know pretty well.
Excellent. Now, we've spoken about the businesses that you own in the portfolio, strong balance sheets, profitable, little amount of debt, if any, and then obviously some changes that you made in the portfolio since we spoke last. We've spoken about the longer term earnings growth, somewhere around 20%, depending on where we are in the year. It might be more plus or minus, which is fine. We've discussed the IRR, so internal rate of return, that you see these portfolios delivering, which is slightly above the longer term average, which is fantastic for listeners. Let's talk about some of the risks you're seeing in broader markets or even the portfolio itself. What are some of the things that you're concerned about looking forward?
Well, this is going to sound like a bit of a cop-out. I said it last time. But we climb that wall of worry on the stocks before we enter them. So we want to have as good of an understanding of these companies we possibly can. And so unless there's some type of black swan and execution within those companies falls over, I think we're fairly comfortable with the positions that we have. And we use the portfolio management to move those weights up and down, depending on the confidence in those companies. And so, like, we're pretty certain that companies we hold are dominant and will continue to be dominant. And if they're not, the weights of those things inevitably start to decrease. And so on a company basis, it's really execution risk that they don't execute as well as the investment thesis should be, or a competitor comes in and starts to take some market share, but that's a lot more slower in time. And then on the economic side of things, I know there is a lot of noise at the moment what these tariffs may or may not do to global economies, but it's really only the US economy that will be hit by these, but there might be slowdown here and there. But that slowdown in economic growth or short-term inflation, which may flare up in certain parts of the US, the inflation is self-inflicted and it can be changed very quickly by spending habits or tariffs getting switched off, deals getting done, or whatever it may be. The slowdown in economic growth can be very quickly offset by interest rates moving down, which by all accounts looks like is what's going to occur. I know with a couple of cuts here in Australia, there'll probably be more through into next year. And so, I mean, in the US, like Trump is fairly intent on getting the Fed to cut rates, but we'll see in time. But economic growth, if that slows off, asset prices should have relief and rise or have an equilibrium with rates coming off. So you've got a balance there. Something terrible happening. We're in a pretty good place. Slowing growth and a lower rate environment is exactly the type of investment framework that our portfolio and growth investing usually does really well in. So there's not too much we're concerned about outside of black swans.
Yep, same. Jolon, I want to wrap it up there because I know you are short of time at the moment and do appreciate you making the effort to catch up with me. So if anyone wants to learn a little bit more about Hyperion, again, do they go to the website or obviously speak to me?
Yep. You pick up the phone, you give Rob a call, or jump onto the Hyperion website. And if you have it on the insights drop-down menu, you can have a look at the company profiles, everything that we invest in, give you a bit of an insight into why we like them and the investment case for that.
Yeah, I'm loving your white paper, so I appreciate your transparency and the level of service you provide to all the advisors out there. So thank you, Jolon, and looking forward to catching up with you in the new year.
Sounds good. Thanks, guys. Appreciate your time.
Good night. Bye.